Good evening, everyone. This is Dana from NexGen, and I hope everyone has had a fantastic week. This evening, we're going to talk about the teaser rate, specifically adjustable rate mortgages. Now, in the beginning of the video, you saw that teaser rates can be used for financial products like buying furniture, credit cards, or even mortgages. So the reason why I want to talk to you this evening about the adjustable rate mortgage is for two reasons. One, because we're hearing a lot about the different mortgage packages that are being offered now in this environment. And two, we're going to be doing a first-time home buyer seminar that's also going to be talking about the environment. And for those that are interested in the other type of teaser rates, I did do a video on that, and I'll put it up in the link above. So what I'd like to do is kind of go over some scenarios to kind of show you the difference of why people are attracted to adjustable rate mortgages. So the scenarios I want to give you fall into three categories. I'm sure there are more, but I just kind of want to give you an introduction into the different types of mortgages that you may be offered. The first one is interest only, and that's basically what it is where you're making payments and you're only making the interest payments. And as we've talked about in previous videos, the mortgage is comprised of your principal, it is comprised of your interest, and if you have what they call an escrow, that would be the property taxes as well as the homeowner's insurance. And in some cases, we have what they call private mortgage insurance. And I'm not going to belabor the point, that is not one of my favorite products. And there's a reason why, but I'm not going to address that today. The other one is what we were talking about, adjustable rate mortgages. And I will show you why a lot of people are looking into those types of mortgages. And of course, the fixed rate mortgage. Okay, in this slide, I'm just going to give you the full picture, if you will. And this is on a $250,000 home. So the mortgage is $250,000. So we can assume for all intensive purposes that the loan amount is equal to the appraised amount, just for this scenario. So in the interest only category, the interest only rate is 4%. On the adjustable rate, the first 5 years, the rate is 1.9%. And on the fixed rate, the interest rate is 3%. Now, I know that in 2022, as of the time I'm doing this video, these numbers have increased. So I'm just giving you a scenario. So on the first row, I'm showing you the interest rates on the first 5 years. So in the second row, I am showing you the payments that will be made in the first 5 years. So on the interest only, it's $833.33. That's the monthly payment. Again, I'm only talking principal and interest. I am not including any escrow. On the adjustable rate mortgage, the monthly payment will be $911.60. And on the fixed rate, the monthly payment will be $1,054.01. That would be the monthly payments on that row in the first 5 years. So after the first 5 years, on month 60, The balance on the mortgage for the interest only is the $250,000. And of course, that makes sense because all you've done is made payments toward the interest. You had this in this scenario, there were no payments made to the principal. So that's why that amount stayed the same. On the adjustable rate mortgage, the balance went down to $218,129.71. And on the fixed rate, the balance after 5 years is $222,763.01. Now, I did want to back up to talk about the monthly payment. A lot of times when a lender is talking to you, you may be fixed on the monthly payment. So even though the interest only rate is the highest out of the three, the payment is the lowest. And then, of course, the adjustable rate is right behind it. And the fixed rate is the higher. So if you're only looking at the monthly payment, you may be looking at interest only. But as you can see, after 5 years, that the principal did not go down at all on the interest only, and it went down a little bit on the adjustable rate and fixed rate. Now, the reason why this is important is because sometimes, depending on the environment, the appraised value of the home can go up, or in some cases it can go down. And I'll be talking about why that's important. So now we're on the last row, we're going to be looking at what the payments are going to be after 5 years. So on the interest only column, the reason why it's not applicable is because on these types of loans, usually the entire amount is due on or before the 5th year. So there will be no payments because the entire amount will be due. So that's where you see not applicable, because the expectation is that you're going to pay the loan off. On the adjustable rate mortgage, the reason why it increased significantly is because the quote teaser rate was 1.9%, and that was only for the first 5 years. And on the remaining balance of the loan, the new monthly payment will be $1,342.05. Now, I have seen in some cases, now that's at 5%. I've actually seen in some cases it has gone as high as 8%. Now, remember, at the beginning, your adjustable rate mortgage the rate was 1.9%. And of course, on the fixed rate, because it is fixed for the life of the loan, on a 30-year fixed rate mortgage, the monthly payment on the home will be the same for the first month as well as the 60th month. So there are some reasons why you would want to do an interest only or an adjustable rate or even a fixed rate. And I'll give you a short snippet as to why anyone would want to do an interest only product. And that could be because, for example, the home that you got the mortgage on was for $250,000. However, when you did your homework, you found that it is actually worth $350,000. So with an interest only package, and you have the funds to within the first year or even 5 years, you have the $250,000. In my personal opinion, that's the only time I would ever go into a interest only arrangement where I actually had or will shortly have the $250,000. So that's for the interest only. So it's not because of the monthly payment. It's because there's an expectation, a very good expectation, that the house appraises for much more than what I put the mortgage on. And I also have the funds to pay the amount off well before the balloon payment, if you will, is due. And that could be the same for the adjustable rate. There's an expectation that you will either, one, you would change it to a fixed rate for, let's say that it's at 1.9, and you have an expectation that you're going to pay off the mortgage. And in the previous videos, I did talk about paying the mortgage off in 5 to 7 years. So as you can see, the balance is lower than the interest only because you were making payments to the principal. So there should be an expectation that, one, the house appraises for significantly more than what you owe, or two, that you are able to refinance the mortgage at something that you're comfortable with. And of course, last but not least, we have the fixed rate. If the fixed rate was 3%, and then later down the line, a few years later, it goes down to 1%, let's say, then you have the option to refinance at that lower rate. But the good news is that, again, with this scenario, as with all of them, you have the opportunity to pay toward the principal. In the fixed rate, it pretty much gives you breathing room if you are comfortable with knowing that payments will be made and you plan on living on the property or living in the home for 30 years, or you are selling it for a profit, if you will, or a gain, that you can use the money to purchase another property. So this is just a scenario and a snapshot to show how people would be looking at interest only, adjustable rate, and even fixed rate mortgages. All right, so let's go ahead and wrap it up. So I do have some alternatives to the teaser rate. One of them would be to improve your credit score if that is something that you need to do. And the reason why it's important to improve your credit score is because the better your credit score is, the more options you have, the more attractive options you have if you decide that you want to get a mortgage to purchase your home. Another thing that you want to do is you want to do your homework. And the reason why doing your homework is important is you want to, after you find out what you can afford based on your budget and based on your pre-qualifications that I talked about in a previous video, you want to make sure that the property or the home that you're going to be purchasing is going to appreciate in value. And this is whether you decide you want to live there for 30 years or 30 months. You want to make sure that that is a place that you want to live for the duration of the loan that you plan on taking out. We don't know the future. However, with a little bit of homework, it goes a long way. Another thing that you can do is you can make a larger down payment. By making a larger down payment, that also allows the finance company to offer you a lower rate. So that's one thing that you can do. And of course, last but not least, you can always refinance the mortgage. So in these scenarios that I gave you with the interest only, adjustable rate, and even the fixed rate, you can always refinance to something that is better suited for your situation. Well, that's all I have for you. I'm definitely looking forward to seeing you tomorrow morning at the New Buyer Seminar. I'll make sure to include the link at the end. Have a great weekend, and I will talk to you soon.